This weekend, Bitcoin did something it hadn't done since 2024. It fell below $60,000. If you went to bed on Friday and checked back on Sunday, you may have slept through one of the sharpest stretches of selling that crypto has seen all year. So in the next few minutes, let's walk through exactly what happened, why it happened, and the one thing you need to watch this week. Welcome to Moon Index. This is Market Pulse, your Monday briefing on the weekend's moves and the week ahead. No hype, no moon talk. Just a clear read on what's driving crypto, tech, and the bigger forces behind them. Quick note before we dive in, nothing here is financial advice. It's analysis. Let's get into it. Here's where things stand. As of this morning, Bitcoin is trading around $63,500, up roughly 4% from Sunday. That bounce is real, but it comes after a painful slide. Over the weekend, Bitcoin briefly dropped under the $60,000 mark for the first time in about 2 years. Ethereum had it even worse. It fell below $2,000 and is trading near $1,700 this morning. To put that in perspective, Ethereum is now down around 65% from its all-time high. And this wasn't just one bad day. Bitcoin has slid from an intra-week high near $73,000 at the end of May to where we are now, a drop of more than 10% in roughly a week. It now sits more than 50% below its record high of just over $126,000 set back in October. So, the question everyone's asking is simple. Why? 4 forces came together at the same time. First, money is leaving the Bitcoin ETFs, and it's leaving fast. These are the funds that let big institutions buy Bitcoin through the regular stock market, and for 2 years they were a steady source of demand. That flipped. Over about 13 trading days, spanning late May into June, roughly $4.3 billion flowed out of US spot Bitcoin ETFs. That's the largest outflow streak since these funds launched back in early 2024. When years of steady buying turn into weeks of steady selling, price has nowhere to go but down. Second, one of Bitcoin's most famous corporate believers blinked. Strategy, the company formerly known as MicroStrategy, and for years the loudest never sell voice in the entire market, disclosed its first Bitcoin sale in years. The amount itself was small. The signal was not. For a market built partly on the belief that the biggest holders simply never sell, that crack in the story rattled a lot of investors. Third, leverage did what leverage always does. As prices fell, traders who had borrowed money to bet on Bitcoin rising were forced out of their positions automatically. That's called a liquidation. On the worst single day, around $1.8 billion in positions were wiped out, the most since February. And that kind of forced selling feeds on itself. Lower prices trigger more liquidations, which push prices lower still. And fourth, the bigger economic picture. Conflict in the Middle East has driven energy prices higher, and higher energy costs push inflation up. When inflation runs hot, the Federal Reserve is less likely to cut interest rates, and may even raise them. High rates are bad news for risky assets like crypto, because investors can earn a safe return just by holding cash or bonds. On top of that, a lot of the money that might have flowed into crypto is going somewhere else entirely. Artificial intelligence. AI stocks are showing real, visible earnings growth right now, and capital is rotating hard in that direction. Put it all together, and the entire crypto market has felt it. Total crypto market value dropped to around $2.2 trillion last week, down nearly half from its peak of roughly $4.2 trillion. This is the deepest correction since February. Now, it's worth staying level-headed. Corrections like this are part of how crypto has always moved. But this particular mix, institutions pulling out, a trusted holder selling, and a macro backdrop that punishes risk, is worth taking seriously. So what should you actually watch this week? One number matters more than the rest: inflation. On Wednesday, the United States releases its Consumer Price Index, the main gauge of how fast prices are rising. Because of those higher energy costs from the Middle East conflict, economists are bracing for a hot reading. Some forecasts see inflation running more than 4% above where it was a year ago. Here's why that matters for your money. If inflation comes in hot, the Fed stays cautious, Rate cuts get pushed further down the road, and risk assets, crypto included, likely stay under pressure. But if it comes in softer than feared, we could get some relief, and this morning's bounce might actually have legs. That one report could set the tone for the rest of the month. So here's the picture: a sharp weekend drop, a Monday bounce, and a market holding its breath for Wednesday's inflation number. We'll break that CPI report down in full in this week's deep dive, so hit subscribe and you won't miss it.